Hey, what's up, guys? I hope everyone's doing well. I know it's been crazy times out there, but I wanted to do a quick video. You may hear a lot of chatter in the real estate community about what's going on, so I just wanted to kind of be able to express to you guys what I've been experiencing and what I've been reading about and researching on. And so there's a lot going on specifically with government loans, and the main reason the government loan space is taking a hit. There's actually several factors. So I wanted to go over a few things to kind of help you guys understand what's going on right now and where I see it taking us in the future. You see, it's my opinion and my belief that now that all this is starting to unfold, it's as a result of the COVID-19 virus, we're going to see a lot of changes, especially in the government lending space. So we've had several factors. One of the largest factors that's going on, we've had huge margin calls in the mortgage industry. There's a lot of really good articles out there about what margin calls are, so I'm not really going to get into that. But it's basically, if mortgage lenders, when we lock a loan, we are hedging our pipeline. So, for example, if I lock a $300,000 loan, we are going to our investors and we're committing to $300,000 from our line of credit. And as the government loans specifically, there's not a lot of investors out there right now buying them. The government loans have all of a sudden taken a huge decrease in value. They're pretty much the values have dropped so much, and there's several factors on why the value of government loans have dropped on the secondary market when we go to trade the loans. One of which is the government came in and they did that $200 billion stimulus package and started buying mortgage-backed securities. So if the government's coming in and buying government loans, then that means the private sector cannot come in and buy the loans, so it makes them worth a little bit less. In a nutshell, I'm kind of summarizing a big complicated thing so that you can understand it. So what happens is, now that those loans are worth less, so we went in and we committed to our hedge fund or wherever, our wholesale line of credit, wherever we're getting that $300,000 loan from. Now all of a sudden, so when we committed to that loan, let's say that loan was worth $5,000 at that time, or that mortgage note that we were going to, the servicing rights to that mortgage, let's just say it was worth $5,000. Well, now it's worth $2,500. So the investors come back and they say, hey, wait a minute, we need you to pay us for the difference if you want to keep this loan locked. So obviously we've got to keep the loan locked to our clients. So the only way to keep that money secured from our investors that we're getting the money from is to pay them the difference of what the value has dropped. So it's super complicated, but that's called margin call. We're seeing that industry-wide. That's every single investor out there. That's every single mortgage lender, whether if you're a mortgage banker, a mortgage broker, or a privately held mortgage company. Everybody is seeing this across the board. Another note, so that's called margin calls. You can do some research on it and learn more about it yourself. It's super complicated, but that's it in a nutshell. Refinances. So when the COVID-19 happened, everybody started pulling out of the stock market and they started buying more secure assets like bonds, and mortgage-backed securities is one of those. So when the mortgage is sold, it is securitized, and they call that security a mortgage-backed security, and it's basically like a bond. So if you think of a mortgage, it's a 30-year bond, so to speak. They know people pay off early. National average is probably about 5 years. But they know they're guaranteed that income, that interest from your loan for at least the next 5 years. Say, for example, you've got a $300,000 note at 5%. It's going to be paying about $12,000 a year worth of interest, something around there. But that $12,000 a year is guaranteed income for whichever investor ends up buying the servicing rights to your mortgage loan, right? So what happens is, with all these refinances are coming in the pipeline, somebody may have just closed their house a year ago at let's say I closed them at 4.5, and they're coming back to me and they're refinancing now at 5.5. Well, the investor that bought that loan thought he had a 5-year investment worth X amount of money. Well, what happened is, by him refinancing, it actually, now the investor is not making any money. They say servicing takes about 3 years before the servicer starts to make any money off of the loans. So what's happened with all these refinances is the servicers aren't making any money. Once again, on government loans, makes them worth less now that the investors know they're not going to be making any money. And also, knowing that the rates may be dropping again in the future, the investors are backing up, saying, whoa, we're not going to be touching these loans right now. So that's another reason for the investors all backing out. So most mortgage lenders, this volume is causing them to max out their warehouse line of credit due to the volume. So what they're doing is they're going back to their investors saying, hey, we need more money, we need more money. And then the investors are looking at it like, wait a minute, you mean these notes don't necessarily perform, or somebody can refinance and get out? It's kind of like back in 2008 when investors didn't realize there were subprime loans mixed into their good loans, and they were like, wait a minute, you mean there's subprime loans in there? Now investors are saying, wait a minute, you mean they can pay off early and my bond's not going to perform? Yes, the bond's not going to perform if somebody pays off early. So that's called early payoff, or EPOs. You can read a lot of articles about that out there. That's dramatically affecting the market because the investors are pulling out, specifically with government loans. Another thing, so when pull-through ratio, so when people, let's say I lock in a loan today and the rate's 3.5%, well, tomorrow the rate drops to 3.25%, and the client ends up hearing about it and they shop me and they go to another lender. I've already committed. And can we get them a lower rate? Yes, but a lot of times what they'll do is they'll just say, no, you were trying to screw me, and they'll hop to another lender. So that affects our pull-through rate. Well, if we've committed to that loan and now we can't deliver it, then that's a bad thing, right? So we lose money, and our investors also lose money that we locked it with. So what they're doing is they're pricing loans a little bit higher, putting in a little bit higher margin to be able to deal with the pull-through, because right now pull-through is a big issue when normally it's not. Normally you have a small pull-through ratio. Now the pull-through ratios are getting, more people are falling apart. Also, if somebody loses their job or we can't close on the loan for whatever reason, that's also affecting pull-through ratios right now, and it's making people a little bit wary, especially on government loans. So people going into forbearance, I needed to touch on forbearance real quick. Forbearance is the government comes out and they say, hey, you don't have to make your mortgage payment if you fall under this specific category. What happens is your servicer is still on the hook to pay his bondholders. So let's say you get a loan and you get a government loan, well, and you filed for forbearance and you don't have to make payments for a couple months. Well, your servicer is still on the hook to continue to satisfy his investors. So your servicers are losing money there, which is making servicers not really want to service these loans. Now, that's specific to government loans. If you've got a government loan, a VA, USDA, FHA loan, your servicer is still on the hook, regardless if you're on forbearance or not. And investors are fearing up to 30%. I'm hearing different numbers. It's raising and lowering, but 30% unemployment rate due to this virus. So, go on, cat. Sorry, my cat's here. So they're expecting a bunch of unemployment, which is going to further drive forbearance, and it's going to further drive loss mitigation. So what do I see happening in the future as a result of all this stuff going on? I think it's going to be a good thing. I think we're going to see minimum credit scores. A lot of investors and lenders have already come out and say, you know what, we're setting a 640 minimum credit score on government loans. So I think gone are the days of being able to get FHA and VA loans with 5-something credit scores. So in fact, yesterday I priced a loan that was a 650 credit score on a VA purchase, and it was like, say if the going market rate for good credit is 3.25, this guy was at 4.5, and he had to pay 1.5 to get it. I think you're going to start seeing more of that, and I'll tell you why in just a second. I think you're going to see maximum debt to income ratios going to 45%. The days of being able to get someone approved at 50% debt's probably over. Is that a bad thing? I don't know. I think you're going to start seeing reserve requirements as well. So normally if somebody's a veteran, I can get them into a house without absolutely any money in the bank. Is that really the right thing to do? So if I don't give him the loan, he's just going to go down the street and give him a loan. Get a loan from somebody else anyways. But I think the industry as a whole, we're not really doing somebody justice. If they've got $500 in the bank and life happens and they have to put a new set of tires on their car, or another storm comes through and they have to pay $1,000 insurance deductible, most people aren't prepared to do that. And a house, comes a little bit more expensive. So I think you're going to start to see a 1 to 3 month reserve requirement for people to get loans. I think lenders are going to, you're starting to see this already. Quicken's already come out with it, and some other large lenders have already said they're not going to allow you to lock loans until the loan has already gone through underwriting. So you got less chance of that loan falling through. I think you'll start seeing more people doing that. I think you're going to see back to the scenario that I quoted yesterday. The guy had to buy the rate down. It was a high rate, and he had to buy it down. the reason is the investors know that there's a really high chance that that guy is going to turn around and refinance that loan a year from now, right? If he's got a 4.5% rate right now, the market is saying that we think the rates are going to stay low, so this guy's going to have to pay points because the investors need to go ahead and make all their money up front. So they're charging the clients a point or a 1.5 or 2 points even to get the rate, because they want to make all their money up front because they know there's a high chance that that client's going to turn around and refinance in the near future. So I think you're going to start seeing more of that. I think the days of lenders being able to provide big old credits, or especially on government loans, those days are probably going to be over. Which I think all this stuff is a good thing for the record. I think it's going to balance our market out. I think we're going to see, I think right now we got a bunch of pent-up interest. You go to Lowe's or Home Depot and it's bustling. I think clients are getting their house ready. I think we're going to have a flood of houses hit the market this spring and summer. And I think what that's going to do is that's going to cause our prices, where you've been able to list a house, and get greedy, I want to get as much money as I can. I think that's going to flatten off and kind of taper back down a little bit to a healthy market rate, right? So you all know, you can't argue the fact that we have been pushing the boundaries and a lot of times getting it with in regards to sales prices on houses. So I think our days of being greedy and being able to get a lot of money for a house are probably going to flatten off. And I think it's going to return us back to a buyer's market. So I think all this is going to cause a swing back to a buyer's market. There's a lot of people that are still out there house hunting. There's a lot of people who have stopped that may be in a service-related industry because their income has stopped. I think those people are going to be scared, but I think they're going to hit the market again. It's not like you say, I really want to buy a house. I'm motivated. I want to buy a house. And then all of a sudden, no, I don't want to buy a house anymore. I think that stays in your heart. And I think these people, although they need to push hold right now because they're nervous and scared, rightfully so, I think they're going to be back in the market this summer. So I think what we're going to see is a huge surge back in our market this summer. So I think you're going to see a lot of mortgage companies close their doors and go out of business. And I think you're going to see another, I don't want to get too long into this, but I think you're going to start seeing a lot of private investors come back into the mortgage market buying different types of loans. I think we need a different securitization model other than Fannie Mae, Freddie Mac, and Ginnie Mae. I think you're going to see some private investors come in and start allowing mortgages for different products, different reasons, different types. So hopefully this video has been educational. I wanted to kind of pour everything that I'm seeing going on out there. I know it's a little bit long, but it's a ton of content in there. Feel free to reach out to me anytime if you'd like to know more, and I'm here to help you guys. We're all in this thing together. I think we all need to stick together as a group, as an industry. We need to support each other. Look, my competitor is not the lender next door. It's not my local competition. My competitor is Quicken Loans, is USAA, is Navy Fed, it's Veterans United. Our competition, guys, is online. It's not each other. So we need to support each other as a group and keep our clients from going online, which is what they're doing right now, because guess what? They're stuck at home. So anyways, that's my 2 cents on that. Hope you guys have a great day.